Hello everyone, welcome to this lesson. We have been on introduction to Forex. In our last video we talked about how we can open our MT4 on our system and how we can add the currencies. We looked at the workspace, we looked at our charts, we looked at how we can change the candles, the colors, and how we can actually navigate through the environment of the trading portal. So we talked about how we have to download our MT4 from the broker's website, and then we can start trading from there. So today I want to show us something. We are still in introduction. This is part 5, and in this lesson we are going to be looking at how we can add what are indicators, how we can add these indicators to our charts, and how we can actually read them in terms of trading. All right, so first of all, there are two indicators I want to introduce us to in this lesson. The indicators are, number one, the moving average, and then the MACD. Okay, so I'll explain further on that. So to add those indicators, you have to go to insert, you go to indicators, you look for trend, then you look at the moving average, you click on it. Now you change the period of the moving average to 20. Okay, you make it a simple moving average, apply to close, you change the color to maybe blue. All right, the line color you can increase a little if you want, then doesn't matter, you say okay. All right, you see the line appearing on the charts. Okay, now we want to add another indicator again. Go to insert, go to indicator, go to trend, go to moving average again. You add another moving average 50. The period is 50. Simple, close. You change the color. Let's use probably an orange color. Okay. All right. So okay. All right. So these are the two indicators we have on the chart right now. Now the last indicator I want us to add to the chart is the MACD. So go to insert, go to indicators, you go to, I think it should be under oscillators, you go to MACD, look at it here, MACD. You need to know this MACD. So the levels are correct. Fast is 12, 26, 9, apply to close, you say okay. All right, so this is exactly what you get on the chart once you have added your indicators. All right, so this is how it looks like, and indicators are helpful to knowing price action. They help you to understand price action. Is that okay? So this is like a lesson on how to understand price action. So the moving averages are indicators that help you to see how price has been moving over a period of time. For example, the 20 period moving average is to show you how price have moved in 20 of the price movement. Okay, and also the 50 moving average helps you to know price movement in 50 periods. Okay, the period of time of price movement. All right, so how do you use these indicators to trade on your chart? First of all, if you want to use these indicators, this setup like this, you have to save it. And how do you save it? You right click on the chart and take your template, you take save template. All right, when you click on save template, you can take the name and set indicators. You can just put something like that, indicators. Okay, and save it. All right, so once you save it, it becomes a template. For example, you want to trade another currency pair like Euro GBP. You can open the chart like this, chart window, and then you right click on it, you go to template, and then choose the indicators. All right, so you just have it directly on the chart the same way you will have it here on the other one. Okay, so that is how we use we save our charts to use the indicators. All right, so very quickly, let me just explain this indicator to you. Now you can see from this perspective the indicator on the 1 hour time frame. You know, I told you about time frame in the last lesson, to the 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, daily, weekly, and the monthly. In any of the time frames you are trading on, you should know how to use these indicators properly. So let me quickly explain how to use these indicators, and then I'll show you one other thing. So when the indicator, for example, on this price action, you can see that when the moving average 20 crossed below the moving average 50, you saw that the price was going down. Remember, we sell high and we buy low, so it means that automatically the price is low, so we can enter a sell. Now if we take our crosshair, look at the crosshair here, look at the crosshair, and you put it exactly here, look at where the indicators crossed, and then look at the MACD. Okay, so also looking at the MACD, you can see that the MACD has volume up and volume down. Okay, it helps you to understand the volume of trades that are going up either on the upside or on the downside. Okay, the MACD has a value of 0, which proves that when price is above the 0 line, it means the price is buying. All right, the market is buying, the market is low and it's about to go high, it's going high. When the market, when the volume is below the 0 line, like this or have here, it means the price is selling, is down, it's high and is ready to come down. Okay, so this is how you use the volume indicator, which is of course the MACD, and the moving averages, to determine when price is high and when price is low, because the golden rule is that you must sell high and you must buy low. All right, so when you see the moving average clustering like this in one place, it means that the price is ranging. Okay, it means that the price is ranging, and then you don't have to do anything, you just have to stay away from the market. But once you see the moving average cross below and the price is below the 20 moving average, and you see the distance wide open between the 20 moving average and the 50 moving average, it means the price is selling, is moving to the downside. All right, so you can see the volume, it changed from being bullish, as we say, to being bearish. Remember, when the price is, when we're buying, we say the price is what? Bullish. It's a bull market. And when the price is selling, we say it's what? A bear market. So this is going short and this is going long. All right, so when the 20 moving average crosses the 50 moving average upwards, we say the price is bullish. And you can see that the volume indicator showed us exactly here that the price is going long. And you can see how the MACD line is directly inside the volume to tell you that the volume of trades to the upside is high. Is that okay? All right, so the same thing happened here. You can see that the price volume was down. All right, the same thing happened here. You can see how the 20 period moving average crossed the 50 period moving average, and then you see the price going up. So once this happens, all you need to look for is to look for buy opportunities in the market. So that is how you use your volume indicator, which is the MACD, and also use your moving average to determine price movement as the market is moving. So you use the volume indicator and the moving average to determine price movement. All right, so that is how to use the volume indicator and the moving average. So we have successfully added 2 indicators to our chart, and we are able to use them to analyze price movement in order to take a decision on what and where to trade. Is that okay? So now, something I want to point out to you is that the market moves in 3 phases. I think we'll talk more on this in our next video. The market moves in 3 phases. It's either the market is on an uptrend, market is bullish, or the market is bearish, or the market is ranging. Is that okay? So anytime you see the moving average clustering around themselves, you know that the market is not moving. For example, what happened here, you can see that the market was ranging. Okay, this is a range. The market broke from the range, it retested the range, and then continued to the upside. All right, okay, so this is what happened here in this market. All right, so you can see the price was trending beautifully down, it was coming down, and then it was going up, and then it came down, went up, came down, it broke above this high, it retested it, and continued up. So that is how you understand price movement. You can see the market was clearly ranging in this place. Market was ranging. This was the range. Market was unable to move above these highs 1, 2, 3 times. It came down, it retested this place, and then came down, boom, and then you see the MACD volume coming down. Is that okay? So this is one of the ways by which you can actually determine price movement. It is very, very important that you understand this. You can see here the market was literally doing nothing. It was ranging all through, ranging, managed to break above the highs, then came back. You can see this is the range. Okay, so it managed to form a trend here, and then it came down. You see the cross and you see the sell. Okay, so that's how you use the MACD volume indicator in conjunction with the moving average to determine price movement. All right, so before you start trading, one of the things you must do is that you must start from the higher time frame in order to determine, first things first, the trend of the market. So as a day trader, rather, you have to start from the 4-hour time frame. All right, so that you can know the overall direction of the market. It is very, very important. All right, so because you have to choose the type of trader you are. Either you are a day trader, you are a swing trader, you are going to be scalping, and I will explain that in a bit. So for day trading is that you want to trade in a day, maybe 1 to 3 trades in a day. You like taking profits in a day. Swing traders, they trade, sometimes 3 days, 1 week, 1 month, they are still in their own trade. For a scalper wants to take profit within 2, 3, 4 minutes, 5 minutes, you are done. Within 1 hour, you've entered the market, take some trades, and you're out. So it depends on the type of trader you are. But for this lesson, we want to focus on day trading. Of course, I'm a day trader. So you have to start your analysis from the 4-hour time frame. Why are you doing this? So you can know the overall direction of the market. Okay, so first things first, I want to show us the different phases of the market. All right, so I want to show us the movement of the market before we look at other things. So first of all, I want you to understand that the market moves in 3 phases. Like I've said before, we have the uptrend when the market is moving to the upside. Okay, then we have the downtrend. Okay, and then we have the ranging market when the market is ranging, no clear directional movement. Okay, so these are the 3 phases the market finds itself. So you can either move to the upside at a point or to the downside at a point, or the market is ranging. The market must be in each of these phases at a time. So how do you now make your trading decision to know whether the market is moving to the downside or to the upside, or the market is ranging? That is where you need to use those moving averages to actually help you determine where the market is moving, and also look at the higher time frame to know whether the market is going up or down. So in this scenario, looking at our 4-hour perspective from the on the Euro GBP pair, which we are trading on the 4 hours, because we say is the higher time frame that gives us a clear direction of where the market is going. So what can you say that the market is doing? So, well, very clearly you can see that the market has been moving to the downside, creating higher high, lower highs and lower lows, lower highs and lower lows. And right now the current low has been violated, and we can see the current high is being violated. Okay, so to understand this further, in market movement, the market moves creating what we call a trend. I think we'll just start from there. In this lesson we'll just start, so that in our next class we'll continue from the trend. So market moves creating a trend. Now in a downtrend, we're expected to have a high, a lower low, a lower high, a lower low, a lower high, and a lower low. All right, so the market will always be breaking its lows, always be breaking its lows, always be breaking its lows. Okay, always be breaking its lows. So the market moves and creates what we call a trend. All right, so when the market is going down like this, it creates a trend to the downside. It is when the market starts breaking these previous lows and start forming higher highs, and then we can say the market has become a bullish market, and it forms a trend to the upside, and then we start having new lows and new highs. Okay, so automatically this is the circle by which the market moves. Market moves to the downside, which is what we call the bearish trend, and then to the upside, what we call the bullish trend. So the market moves creating highs and lows, lows and highs, and lows and highs, and lows and highs. Okay, just like that. So in a downtrend, what we expect is a high, is a lower high, a lower low, okay, a lower low, sorry, a lower high, lower low, a lower high, and when that low is not broken, it forms a high, then it forms a higher high, a higher low, and then a higher high. So basically what the market does is this, what we call let me use this now. Okay, so the market starts with a high, what we call a high, all right, and then it forms a lower high, okay, and then it forms a lower low, okay, and then it forms another lower high, which is this, sorry, okay, and then it forms, let me clone this, a lower low, just like that. So in a downtrend, the market starts forming lower highs and lower lows, lower highs and lower lows, okay, while in an uptrend, the market forms what we call, it starts with what we call the low, okay, and then it goes to sorry, I'll be here, a higher low, oh sorry, higher high, to a higher high, I'll be here, okay, higher high, then it forms a higher low, and then it forms a higher high. So please take your time to understand this concept very well. So as the market is moving, it's forming on a downtrend. We are looking for the first is the high. Okay, you look at the lower high, it forms a lower low, forms a lower high again, forms a lower low until that low is broken. Until that lower low is broken, a high is not formed. Okay, so the market forms a high first here again, and then forms a low. And remember, what do we do in an uptrend? We buy low and we sell high. This is the secret behind trading. Get this thing and get it straight. You sell low and you buy high. Okay, in a downtrend, we sell high and we buy low. All right, so when the trend is moving to the downside, we look at the highs to sell and we look at the lows to buy. Okay, so this is how typically the market moves each day or each week or each month, depending on the time frame. So in every time frame, you have this movement of. In our next lesson, we'll conclude. We'll look at other things, and also we'll conclude on the lows and the highs. Thank you very much.